The Accidental Entrepreneur is brought to you with the help of our sponsor, AWeber, the world's leading small business email marketing and automation service provider. Since 1998, AWeber has helped more than 1 million small businesses and entrepreneurs through its suite of web-based email marketing, automation tools, and education. AWeber, the best option when it comes to marketing your business. The podcast is also brought to you by the Alternative Board. Since 1989, the Alternative Board, or TAB, has been one of the leading peer advisory and business coaching organizations for independent business owners and CEOs across the world. By facilitating peer advisory boards, private one-on-one coaching, and strategic planning services, TAB helps business owners improve their businesses in ways that change their lives. And be sure to connect with our affiliate sponsor, GSM Growth Agency. They're boosting e-commerce businesses to 6 and 7 figures in revenue and cover everything from ads and social media influencers to making your website better. GSM Growth Agency focuses on taking businesses from startup success to bigger success, going above and beyond to make sure growth sticks around. They're all about cool ideas, lasting partnerships, and making your mark in the e-commerce world. And be sure to support the podcast by ordering some logo merchandise from our online store. Listen to all of our sponsors' commercials later in this episode and follow their links in the show notes to learn more about their products and services. Right, they don't move that fast.
Just don't move that fast, right? So How do I get a deal done in 3 weeks? And I remember, you may remember this story, the founder of FedEx, right, wrote a paper for his master's thesis, right? And the professor gave him a D, right? He's like, man, this is a terrible idea. It'll never work. He's like, what are you talking about? Why would people pay to have something tomorrow when the post office will have it there in like 5 days, right? And you remember their slogan, forever, for like decades.
When it has to be guaranteed.
When it absolutely, positively has to be there overnight.
Yeah.
Right?
Yeah.
And those people aren't going to pay 25 cents. They'll pay $35.
Right.
Right?
Yeah, because it's not reliable. They can't wait 5 days. They're doing a deal. The paper's got to be there to close, let's say. We got to overnight a package. Yeah. It's funny that he got a deal.
And the bridge loans are kind of like that on the lending side, when you absolutely, positively have to close the deal.
All right. Welcome back to another episode of the podcast. We are going to be talking about, we're going to meet Malcolm in a minute, and we're going to talk about his background as an entrepreneur. If you're watching on video, you see him on screen. And we're going to be talking about financing because Malcolm's in the finance business. A lot of business owners have trouble getting financing. How do you become bankable? How do you get financing if you're not bankable? And we'll get into all that stuff. So let's get on with today's show. If you are listening on your favorite podcast directory, be sure and leave us a 5-star review. If you're watching us on YouTube, subscribe, like us, so we can keep bringing the kind of content that we're going to bring to you today. So let's get on with the show.
The information provided in these episodes is for entertainment purposes only. It is not a guarantee of success or to be construed as advice of any kind. You should always seek advice from local licensed professionals before making any decisions.
The dictionary defines an entrepreneur as a person who organizes and manages any enterprise, especially a business, usually with considerable initiative and risk. People often start a business without much choice, perhaps due to a job loss or just being dissatisfied at work, and they come up with an idea they just know can be successful. They become entrepreneurs by accident. That is to say, their success or failure happens by accident, not with intention. My name is Mitch Beinhacker. I'm a corporate attorney and a business advisor. You're listening to The Accidental Entrepreneur, my podcast about how to achieve success on purpose, not by accident. Join me along with our monthly guests where we share our knowledge and help you get a hold of your business. And now on to today's episode.
Hi, I'm Malcolm Turner with Castle Commercial Capital. I am a commercial lending executive. We help investors and business owners get financing for their commercial deals. And we specialize in doing the deals that are difficult to get done, the hard deal.
All right, Malcolm. So welcome to the show. Thanks for joining me this morning. What part of the country you live in?
I'm in Southfield, Michigan.
Oh, okay.
Just north of Detroit.
So what's the weather like up there? It's supposed to be like 80 degrees here. It's not normally 80 degrees in New Jersey.
No, it's pleasant. It's fantastic.
Yeah, good weather.
Yeah.
Turn you up a little bit. Okay. Well, why don't we get into a little bit about you, your background, experience as an entrepreneur, how you got into financing, and then we could share later on all the tips and tricks and advice for people. Does that make sense?
Makes sense.
All right. Go ahead.
Well, I started out, I founded Castle Commercial Capital 16 years ago, 16 and a half years
Okay.
ago in February of 2007. Me and a partner of mine set up the
Okay.
company, and it was the intention was I was actually complaining about, I was doing residential at the time, and my manager was berating me about not selling a first-time home buyer a $300,000 option arm,
Right.
which, you know, would have completely blew up. We knew, 2
Right.
years later, the whole thing with the crap in the
Yeah,
handbasket.
exactly.
But
Right. Exactly.
I was like, listen, the guy's a first-time home buyer. Shouldn't we do the right thing? I put him in a fixed FHA, mortgage, nice
Right.
low interest rate. And
Right.
he's like, yeah, but you made like $600. You could have made like $4,000,
So the flexible ones they're paying higher. They want to push them.
And so, right. And so I was like, well, I gave him an $800 mortgage, an $80,000 mortgage. That was FHA versus a $300,000 option arm.
Right. Where you didn't have to put anything down, very little. Right.
Yeah. But that mortgage payment would have increased like 4 times.
Yeah. Wouldn't have been able to pay.
And he would have lost his house. And I said, well, aren't we supposed to do the right thing? Oh, there you go, Malcolm. Talking that do the right thing stuff again.
Right.
I'm talking about making money here,
Right.
And so I was talking to my pastor about why is doing the right thing a badge of dishonor,
Yeah.
And he was like, well, Malcolm, if you're going to create a mortgage company and start your own, what would it look like? And I was like, oh, I'd do commercial number one because it's all about the math.
Right.
Right. And it's not about the kitchens or the, how wonderful the backyard is. It's me making money and what are my, return on investment objectives. And he's like, well, how would you do that? I'm like, well, you have to open up an office and you have to get some furniture. You have to build some lender relationships and, blah, 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 blah. Boom. This is how you do it. And he's like, all right, great. Let's do it. And I was like, whoa, I thought you were talking hypothetical. I was just talking, And he was like, no, we should do it. You're a smart guy. I trust you with money and, we should do it. And I was like, okay.
How long were you working in the business at that point?
I had been in financial services at that point, probably 10 years, 11 years.
But not all lending.
Not all lending. Lending, right. I was a financial advisor. I became a financial advisor in like 94. Okay. And we got into lending because there was a firewall. You couldn't do financial planning and lending. And then Glass-Steagall got repealed. And, Citibank became Citigroup. And then everyone was doing everyone else's business. You know what I mean? Insurance companies started offering investment accounts, vice versa, blah, blah, blah. Right. So I got into lending probably 2000 and I think I did my first loan maybe 2004.
Oh, okay. So you're talking, almost 19 years ago.
Yeah. Yeah. And and I liked it. It was great business, and we couldn't be busier at the time. It was, you couldn't get enough appraisals done. That was the bottleneck. Sure.
Yeah, it was hot. It didn't crash until 08, 09.
Right. And so many people had years of higher interest mortgages that when rates first dropped, you couldn't do them fast enough.
Yeah, it was a feeding frenzy.
Yeah.
Now, why did you like lending more than financial advice?
Well, one, I never liked the compliance end of financial advising in the sense of why did you recommend this mutual fund, to Mitch?
Suitability and all that stuff.
Well, why didn't you recommend all these other things? Yeah. And it's like, come on now, as bad as it's enough to be responsible for the stuff I did. Now you want me to be responsible for the stuff I didn't do,
Right.
And
compliance.
it was just getting to be a lot, and margins were shrinking,
Right.
And that was when people were getting in the fee based, and there was this whole war in the business at the time between commissions and traditional financial
Right. Versus
services and
fees. And,
fee only, and that whole thing.
Right.
And lending was just it was very lucrative and a ton of value add, because everybody's happy when you take them out of like an 8% mortgage into a 4% mortgage.
Right.
There's no such thing as an unhappy customer at that point, as long as you close.
Because there are no customers that go from 4 to 8. Those don't exist. So
versus the market where, hey, the market went down 1,000 points. Dude, just wait it out. It's going to be okay.
Right.
It's going to be fine.
Exactly.
And every time, you do the dip, and it's like, listen, you started at 30,000. Your account's now 120,000. Okay. Yeah, it got up to 150. It's coming back down to 130, but it's okay. It's the long term. And having the same conversations over and over again.
Yeah.
It's just
compliance is a problem. I've had a couple of financial advisors on the show, but I've given up on it because every time I have somebody on the show, compliance gets involved and they're like, you can't say this, you can't say that, you got to edit this. I'm like, I can't edit it. We recorded the episode. So I won't have them on the show anymore.
Right.
I know a lot of financial advisors, they want to come on the show. I won't.
Right.
I won't
And they have to approve everything that you say in advance, everything that you do. And I'm like,
I had to scrap episodes. Like, we just couldn't publish them. It was just crazy.
Yeah, exactly.
It's crazy.
Exactly.
And we're not recommending stocks. I mean, we're just talking about their history and their business experience, and they didn't like it anyway. So I just stay away from that stuff. So that's totally understandable. In lending, you could focus on it, you could do the deal, get it done, help people. And then you don't have to be babysitting them all the time.
Right. And save them money. Right.
Yeah.
Get them the cash they need to, whether pay for college for a kid or, expand a business, help them out. And they, were glad to do it. And then, so, Reggie said, let's do it together. I was like, okay. And just like that, within a couple of months, Castle Commercial Capital was born.
So Reggie was your pastor?
He was my pastor.
So that wasn't his. But that wasn't his full-time job. He had another occupation, or
no? He was a full-time. He was a full-time pastor, and he was part-time. He was a real estate investor.
Got it. So he owned some real estate. So he decided he would put capital into the company.
Yeah, well, because as soon as I said, "Wow, that's a good idea," but here's the thing, Reggie, I love you like a brother, and I did.
Right.
I say I did. Because unfortunately, Reggie passed away.
I'm sorry.
But I said, listen, bro, I love you like a brother. And I trust you too. And you are awesome with your business acumen, which he was. He was a great businessman. I goes, however, you don't know anything about lending.
Right.
So in the spiritual perspective of a concept of being evenly yoked, we're not going to be, and it's not going to feel good, sharing 50% of the profits and I'm doing all of the work. Right. No, no disrespect. It is what it is. And he was like, you know what, Malcolm, you're absolutely right. You're 100% right. I get that. I tell you what, how about we do this? You set it up. You're going to have to train me on all the stuff I don't know. You'll have to establish the relationships with the lenders. You know how to do that. But I'll fund it.
Okay.
And then I was okay.
Right, but what funding did you need? He's not going to fund it. Like, he's not funding the loans; those are coming from the lending relationship. So, what kind of startup capital you need?
Well, you need it. Setting office, just the basic stuff of setting up an office. Furniture. You got to pay security deposits on leases, and you got to buy
some basic startup.
Yeah, just basic startup stuff. Computers, printers, blah blah blah.
But he was also going to work in the business, and he did.
Yes.
Okay.
Yes, he did, and unfortunately, he got pancreatic cancer.
And that's not good.
And so, early on, like within
pancreatic is a death sentence. Prostate, everybody gets prostate, and my dad died of prostate cancer. It took 11, 12 years for it to come back. Pancreatic, I have a cousin who's 60, and within a year and a half, he died.
Yeah, pancreatic cancer is nasty because you don't.
It's nasty.
Unless you're really going to the doctor on a regular basis, they almost never catch it early.
It's too late, right?
And it because of where it's at, it spreads and blah blah blah. Yeah, it's a very low survival rate.
Right. Yeah.
On
I'm sorry. I'm
yeah,
sorry you
on that
lost him.
one.
So how long did he work in the business with you? Did you
Not
have
even
him
a
around?
year.
Really?
Yeah,
Nice.
not even a year. And I had to, um, say, okay, listen, you got to focus on you.
Right.
You put because he was also my pastor, right?
Right.
And I did love him like a brother, you know.
Yeah.
And so I was like, listen, you got to don't worry about the business. And he was like, Malcolm, but we started this thing out together, and I'm leaving it all on you, and I feel like I'm bailing on you, and that I'm like, no, 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 no. Look,
Right.
don't. This is a long-term deal. It's a long-term legacy for my family, for your family. Do what you got to do to get healthy. You put
Right.
100% into that. I'll take care of this. We'll be fine. You know, and so that's what I've done, and still, even in my book, um, when I reference the founding of the company, I say, look, I co-founded this company.
Hmm.
I didn't like, in other words, I wasn't the founder by myself.
Right.
And I still
Yeah.
give, and on my website, castlecommercialcapital.com, on our origins, I talk about me, Reggie and I, doing this thing together. So, mad props to Reggie Caldwell.
Yeah, because he's the one who said you're doing this, and you got you started. You might not have done it without him, right?
Yeah, well, it was totally his idea.
Yeah.
It was totally his idea, and I was like, all right, well, I got to talk to my wife, and Ian talked. He said, oh, that's fine. I was like, yeah, I'm sure you got to talk to us. No, I don't. I was like, oh, okay, you don't have to.
Right.
Well, I got to talk to mine,
Yeah.
bro.
Right.
So,
Yeah. I keep peace in the family in the house.
you know,
Absolutely.
but
Yeah.
yeah, and his mom, Bertha, was my partner after he passed on.
For a while, she worked with you.
Yeah, yeah,
Oh.
yeah.
Okay.
Just for a little bit, but she was obviously she was his mom. She was much older, and so but because the company was owned between his LLC and me personally, so Castle,
Okay.
it's a little inside baseball, but it was like it wasn't Malcolm and Reggie, it was
Right.
Malcolm and then his LLC. Well, his LLC was him and his mom.
Got it.
So when he passed away, his mom became
That,
100% owner of that LLC,
right.
which made her 50% partners with me.
Got it. Got it. Got it.
So and we had a great, her and I had a great relationship. Needless to say, and
Now, was it difficult to get started on a business like that in terms of lender relationships? I mean,
nope,
people, no,
mm-mm.
just got to sign up and say, hey, listen, we'll offer you products if you like their portfolio.
Absolutely. Well, because understand the essential. People, we have all these fancy terms. My job, I sell money.
Yeah,
I
of
sell
course.
money in America,
Yeah.
right? As a mentor said to me 15 years ago, he's like, Malcolm, there's no greater business than selling money in America. Taking the A off.
Right.
He's like,
Exactly.
everybody understands our business. Everybody wants our product,
Yeah.
and generally, if I'm charging 2 points and they're getting 98%, that's a trade 99%, 99.9% of the country will make.
Right.
So it's not like they're paying us 30%. You
Yeah.
see what I'm saying? It's not even a 10x
Right. No.
return.
Just making some fees up front. Right. Exactly.
We're providing bigger than that relative to what they pay us. So, it's never a question of me, quote unquote, buying the product. It's more, can I get it?
Got it. So it's really up to you to do the screening and the due diligence of the products and say, okay, well, this lender and these products work for clients. So are you sometimes going to market looking for other relationships because you have some difficult situations, or you pretty much have your list of,
Oh no,
lenders?
Mitch, I'm looking for relationships all the time.
Yeah, because the market's always changing.
Market's
right?
always changing.
Products are changing, right?
And the players.
Yeah, of course.
The players change. I was on the phone
Right.
with a lender, a new lender yesterday, but the rep is an old relationship
Who went to this new
who
lender?
went to this new lender. And
Right.
if you go to LinkedIn and you look at the typical commercial banker, commercial lender,
Mhm.
right? Commercial loan officers at banks in the banking industry, on average, they probably change shops every 3 to 4 years.
Okay.
It's
Yeah.
rare to see someone who's been 10 years, 15, 20 years at the same shop.
Right.
That's extremely rare, you know.
Yeah.
And I've got 3 loan officers that work for me, and I understand the competitive nature of the business, right?
Yeah.
And I support my guys, so that they don't,
Jump ship.
ideally they don't leave, but
Right.
everyone, you know,
Eventually. Right.
eventually at some point,
New pastors.
yeah,
Yeah. Yeah.
they're going to die at some point, so they're going to leave
Right.
me,
Not going to
right?
stick around. Exactly.
No matter what,
Exactly.
right?
Yeah. So what kind of industries have you lent to? Have you worked with certain industries more than others in terms of small businesses? And because we can focus on those and what their needs are, is it all over the
Well,
place?
our focus as a practice is around the commercial real estate investor.
Okay.
Okay.
So people that own, multifamily housing, warehouses, office buildings, whatever it happens to be.
Exactly.
Okay.
Now, we do work with business owners when it comes to their commercial real estate acquisitions. So
Got it.
the guy who's got, example, I had a business owner, he had a building next to him. Rather, his building was like 5,000, 5,500 square feet, and the guy had just been rocking. Like COVID didn't mean a thing to him. He had an HVAC company,
Yeah.
and his profits were like straight up. He
Yeah.
literally went from, I want to say 3 million in revenue to 4.5 to 5.5 to 7 to 10. He was just, rock star, just a rock star manager. And our bank, I say our bank because the bank that I personally keep Castle's business accounts with was his bank.
Got it.
Okay. They'll remain unnamed because they screwed him. So I'm not going to say who they are.
Yeah, we definitely won't name them.
But
right.
he got like 10 days away, a week away from closing. And they're like, yeah, we're not going to do this deal.
I've seen they went to like the final loan committee and they wouldn't do it, or something changed at the bank and they had too many loans out. What was the reason?
Yeah, well, we don't really know.
You never really.
But I can tell you what I suspect happened. One, my bank at the time went through a merger. Okay. And bank mergers are never mergers. They're takeovers. The only question is which one. It's never like a merger of equals.
Right. No, never.
Do you know what I'm saying?
Right.
So our bank that him and I were with were being taken over by this other bank. And they probably had a situation where they said, you know what? You guys may approve that, but there's a new sheriff in town.
Right.
So, yeah, we don't like that deal no more. Or we just, because of, again, macroeconomics, we just don't want to take on that new debt right now.
Right. Exactly. It might not be you. It might be like, you know what? We lent too much money this month or this quarter or whatever, and we're not going to do that deal.
And in my book, Financing the Unbankable Deal, I talk about the top 4 deal killers. Okay. And one of them is external to you, the investor.
Yeah.
It's the lender. They may have, example, let's say you want to finance a self-storage facility, highly profitable. You're 100% full. Okay. Why wouldn't the bank do that loan? Right. Well, maybe
cash flow,
on the other side of town, they had another self-storage facility that went under.
Right. So they're skittish about it.
So now they got bad debt. in that
Right.
sector. And
Right.
every bank has allocations.
Right. They can't have it all in one.
Right. And so they allocate based on sector, a property type, based on location.
Uh-huh.
So you may have a situation where, man, they love the deal, but you know what? We just got too many deals.
Right.
You know, I had a
Yeah, it has
great
nothing to do
lender
with
in
you.
Washington State that I was working with,
Uh-huh.
and I found these guys, and they were really a great. They still are. They're great partners, a great niche. And I was like, oh my god, I could do a lot of deals with these guys, right? And then last year, the guy said to me, "Hey Malcolm, you got to slow down, dude. We're getting overweighted in Michigan."
See? There you
And I'm
go.
like, well, you got other, I'm sure you got other brokers besides me in Michigan that's feeding you. Because he's like,
Yeah, of course.
yeah, but not like you. Hey,
Right.
you're,
You do a lot of volume.
yeah. And so, yeah.
Yes.
And so I got to raise some more money. You're causing
Right.
Chris, who was his partner, who was on the equity, because they have an income fund, right?
Right.
The income fund raises money from investors, right?
Okay.
And then the lending division loans that money out on commercial real estate.
Right. They got to put the paper on the street somehow.
So he's like,
right?
you're forcing Chris to go out there and work harder because he's got
Right. To find more.
Yeah, because the only way for us to do more lending in Michigan, because of allocation restrictions, right? We have to grow the bigger pie.
Yeah.
So that piece of the pie can get bigger.
Right. But that's not what you're doing. You're just trying to lend out the thing. You know, I have the same problem with cannabis companies in New Jersey. Cannabis is now adult use is legal, but you can't just put it in any bank. So some of these local, state chartered banks, they take customers, but they can only take so much. Like how much cash can they have on their books?
Right.
It affects their lending, ratios and everything like that. And then they shut down. They go, I'm sorry, we're small. We can't take any more, customers because it's going to affect what else we can do and our things, reserve rates and all kinds of stuff. So I understand that there's a lot of times where you get declined on the way down or they won't do the loan. And it's got nothing to do with you.
Got nothing to
And
do
you
with
don't
you.
know.
So when this guy got, going to the earlier story, when the guy got, declined, and they didn't really decline him. Banks don't like to decline people outright. So what they'll do is they'll ask you for a condition that, Mitch, they know you won't satisfy. Right. Or something that'll tick you off.
Right. So then you'll turn down
the loan. And like they had said to him, well, we need a new appraisal. We need a new environmental. And the guy's like, whoa. I've paid 10 grand for all of that stuff. And my numbers came in. Right. Yeah. So why would I have to pay again? Well, we got new sheriff in town and they want to see new da-da-da-da. And he's like, okay, so if that comes in good, because there's nothing wrong with the one I got. So if that one comes in good, that's another certified appraiser. You still going to guarantee my loan? And they're like, well, we can't do that. We can't get. So he's just like, So another person at the bank said, hey, listen, call this guy. Castle Commercial Capital, but don't tell him you heard it from me.
Right. He'll find something.
I banked there. So, that's where when those title settlements come in, that's where I'm putting the money. Right. So he was like, well, I never heard of these guys. And they're like, that's okay. So he did a Google search and, saw our, ratings on Google. And then he went and Facebook some real estate groups and say, anyone heard it? Oh, these guys are awesome. He's like, oh, okay. Called us. Long story short, we did an SBA 7A loan and we closed in like 58 days.
That's pretty good. SBA is tough to work with.
And all his buddies were like, there's no way.
Right.
Because he asked me up front. I was like, well, we could do this. Because he's like the seller of the building he was trying to buy was next door to him.
Right.
And it was 30,000 square feet.
Big.
Yeah. So he's like, I can do 15, 20 mil out that location. I got to get this building. And these guys been putting us off.
Right.
Now I got to go back to the seller, start all over again.
Right.
And he just wants to retire and go to Florida. Right. So I don't have as much time as I did before. And I was like, look, 60 days tops. Are you sure? I'm like, I'm positive. I've done it before. I'll do it again. It's okay. He's like, all right. And then his buddies are like, dude, he's lying. He's stringing you along.
Right.
There's no way. SBA is the government. Come on.
Right. Yeah. That's always what holds it up.
But, and this is for your listeners, right? There are what's called preferred lenders.
Right.
Okay.
With SBA.
Any bank can go to SBA and submit a loan for funding. And the SBA doesn't do the loan. They just guarantee it.
Right.
Right. So if the loan goes bad, that bank gets back 75, 80% of what they lent out.
It's like insurance. Right.
It's insurance. Exactly. But if you are a preferred lender under their PLP program, you can underwrite, close, and fund an SBA loan without prior approval.
Okay.
So you have a fast track, because you've done so many of these, the guidelines in and out.
You basically have to do the underwriting in-house, and they're relying on you to do it correctly, and maybe they audit you at one point. I mean,
but part of getting into the preferred lender program is that lender has done a certain amount of volume, right?
Got it.
And they've met the benchmarks that SBA, has laid out to be part of that program that allows them that leeway.
Got it. Like, they don't have a high default rate to pick.
Yeah, because a typical lender is going to have to take the loan pack. They got to approve it in-house first. Then they take the loan pack and they send it to Washington, D.C.
Right.
There's some guy there says, yeah, you got to change this, this, and this. And then it comes back. And then they got to, go through it again. Then send it back to D.C. And then that's why they can take months and months and months, right?
Right.
But if you got a PLP lender that's part of the preferred lender program, they'll say, oh, this will happen, this will happen, this will happen. We're good to close. Yep, they close, they fund it. And then they worry about the SBA later.
Got it.
And for me, I'm not an SBA lender, but I am affiliated with PLP lenders that have that status.
Right. You place the loan with them and then they have the status.
Right. Even though in our growth in 2019, Castle Commercial Capital became a lender.
Oh, I see. Okay.
Yeah. So we were doing brokerages for the first, 13 years.
Right.
And then a $1 billion income fund approached us and said, hey, you have any paper you want to sell? And we're like, no. And they're like, you're just a broker? And we're like, yeah. He goes, but you're on the first page of Google. When I do commercial lending in Michigan, and I'm like, yeah. He goes, so you must be doing something right over there, and I'm like, yeah, we do okay, and he's like, well, so you're not a lender? Nope. You want to? Because you do enough volume, we'll buy your paper.
So you're saying you can originate the loan and then you sell it to them?
Well, everybody does.
Yeah, I know that's how it works. But so they're kind of like your warehouse line, kind of, right?
Yes, sort of. So they're the guy after the warehouse line.
Right. They're not funding it. You're basically Well, so you have warehouse lines that fund the loan. And
so
then
like when you have a warehouse line, right?
Right. It's like a big credit line.
It's like a big credit line. So you lend, you do the loan. I say me. I do the loan and I pay for it off my credit line, right?
Right.
And then I sell it to some other entity.
Right.
They give me the money. I pay off my warehouse line for that amount because the money's not meant to live there. It's just temporary.
Right. It's just temporary.
Right. And then the whole thing goes all over again. Right. So, these guys, these income funds, you have a relationship with, and you got an agreement, and you say, hey, any loan that fits within this box. Right. We will buy. Okay. So, depending on your arrangement with the fund, you may have a pre-underwrite where I'm taking the application, and instead of me fully funding it and putting it on my warehouse line and that whole thing, I may have a relationship where I'm sending it to them and they're underwriting it. Okay.
Oh, okay.
and they're agreeing to buy it such that I'm not selling it to them days or weeks later. I'm
Right. It's
selling
all
it to
set
them
up
at the closing
before you
table.
close. Got it. Right.
So the loan is with me, but I
Right.
also have a purchase agreement
Right.
with the fund, and the
Right.
fund buys my paper. So that mortgage gets recorded at the county, and so you may have a seller that I'm funding the purchase of the property, and there's another purchase agreement on the paper
Between you and the fund.
and the fund. Yep.
So ultimately, everything gets recorded in the fund, in the owner's name. The end user, the end mortgage,
Yeah. Correct.
Right. Got it.
Correct.
So you don't have to refile everything and re-record things.
No, it happens all at the same time. It happens, but again, it depends on the relationship that of that
obviously,
fund,
and maybe depend on the deal
yeah.
too. Right.
So in that particular situation, that mortgage never hits a warehouse line.
Right. You don't have to. They're funding the money at the table.
At the table, and it's called
like
table funding.
real estate, right?
It's called table, and the money's being wired in by that third party up front. To the borrower, it doesn't really make a difference. I mean,
no, not at all.
Whether I put it on a warehouse line or whether I fund it at the table, it doesn't really make a difference to them.
To them, no.
Yeah.
So if you're, from a business standpoint, right? If you're originating the loan and you're selling the paper, whether it's at the table or afterward, are they paying a premium for the loan and you're making money on that sale, or are you taking a hit in order to get it off your books?
Oh no! Well, no. The
say it's $1 million loan. They're buying a piece of real estate.
So you think about lending this way. Every commercial real estate investor, at some point in their maturity in the business, they have to understand where 10-year treasuries are.
Okay.
Everything is based off of 10-year treasuries.
Okay.
Whether the Fed increases rates or drops rates or whatever adjustment they make, it doesn't care. What did 10-year treasuries do?
Okay.
If 10-year treasuries move up because of the Fed, or they move up independent of the Fed, my rate's still going up. The cost of capital that everyone pays.
Sure, because you're selling money,
goes
like
up.
it said.
There's no the basis of all of our lending is going to be treasuries.
It's all tied to the 10-year treasury.
It's all tied to the treasury, exactly. So whether rates move on a weekly basis depends on what treasuries do, right?
Right.
So the cost of capital, when banks lend, everyone's lending on the margins.
Okay.
Right. So when Chase does a loan to you, Fannie Mae is buying that mortgage from Chase.
Right.
Right. It's a Chase loan, but Fannie Mae and Freddie Mac are providing the secondary market for residential mortgages.
Right. Okay.
Right. Which is why no matter what bank you go into in America, that loan application is exactly the same.
Right. Because it's all their forms.
Because it's a Fannie Mae 1003, Freddie Mac, I forget what they call it, 10 something. It's the same form. And every mortgage that's written on that application can be sold later to Fannie Mae and Freddie Mac, which is the ultimate in the secondary market. So they may be lending the money at 6, the bank is lending it at 7, and it's that 1% margin that they're making money on, right?
Got it.
You take that $1 million mortgage, right, and you say, okay, what's the cost of capital when you amortize that thing out over 30 years? And you say, okay, what's the net present value right now of that mortgage contract?
Okay.
Then that'll
including
dictate
all the cash flows, discounting all the cash flows backwards to a present value number.
Right. And then they're going to give me that number. And then hopefully that number, if my underwriter's done their job right, is more than what I loaned you.
Right. Hopefully.
Right. So if I loaned, is easy math. If I loaned you $1 million, okay, the net present value, that number better be $1,050,000 or $1,025,000 or some number north of that $1 million.
Well, if their discount rate is lower than yours, their interest rate that they're using to net present value, then it'll be higher. Is that the way it works?
Well, because
Or
ideally,
the other way around?
the this is where Silicon Valley got in trouble, right?
Right.
When rates go up, okay,
Right.
if I'm holding paper that's at a lower rate,
Right. The value
the
goes down.
value goes down.
Right. Just like bonds.
Exactly. It's exactly
Right.
what it is.
It's like a bond, basically. Right.
Exactly. So, speed becomes important between how fast I write that paper and how fast I sell that paper, because I don't want to get
Right.
caught in a bad situation.
With any changes.
Yeah.
Right.
Yeah.
Yeah. Okay. All right. Well, that makes sense. Yeah. I mean, a mortgage, whether it's commercial or residential, really is like a bond being issued by an individual or a small company. Bonds are, people lending you're lending them money.
That's exactly
and
right.
They're paying you a rate. That's what happens with okay. That's interesting. All right. Well, let's take a commercial break, and then we'll come back, talk about your book, talk about the things people should know when it comes to lending and borrowing for the business, and how they can become bankable, or what can they do if they're not bankable. Does it make sense? Mm-hmm. All right. Let's jump to commercials then.
Here's a word from our sponsors.
Looking to market and grow your business? Or perhaps you're just getting started and want to hit the ground running? AWeber is the best choice for online email marketing and automation of your business. From maintaining a subscriber list to drip campaigns and landing pages, AWeber gives you tools and integrations that make marketing easy and fun. As our partner and sponsor, we use all their tools to promote the podcast and market our law firm. AWeber, the best alternative for online marketing. For over 30 years, the Alternative Board, or TAB, has built a thriving community of forward-thinking CEOs and business owners who want to radically improve their companies. Through unique combinations of one-on-one business coaching, participation in monthly TAB board meetings with other non-competing owners, a suite of strategic tools, and customized strategic planning workshops, TAB membership can deliver greater strength to your business and a better work-life balance for you and your family. All packaged in a streamlined and affordable service that the people at TAB invite you to try risk-free. Are you struggling with managing advertising due to a lack of time or expertise? Perhaps you're facing challenges in scaling ads for your store. Are you feeling lost when strategies have no success? GSM Growth Agency is your reliable partner in overcoming these business challenges. Feel the impact of collaborating with a team dedicated not only to short-term goals, but also to building long-term partnerships and achieving sustained success. Embark on an exciting journey to redefine the possibilities of e-commerce and create a legacy of unparalleled excellence. Take decisive action now. Follow their link in the show notes to receive a complimentary audit of your Shopify store conducted by a GSM expert. Propel your e-commerce game to new heights with GSM Growth Agency.
Follow the link in the show notes to learn more about all of our sponsors. And now back to our show.
All right, we are back. So, Malcolm, you were sharing about the business and how lending works. I think it helps people to understand, the difficulties, but it also comes down to working with people who know what they're doing, and have experience in the business and the right relationships. But you wrote a book,
Mm-hmm.
right? Financing the Unbankable Deal. Let's talk about, the kind of things that you tell customers and advice you give them when they're a business owner, they're looking to lend. And you had said before, you lend really hard assets. You're looking for real estate to be part of the deal or only the deal. And that's what you're looking for. But can we talk about both, about, a business borrowing money versus, borrowing money to buy a building? And they're different, I would assume, because there's no hard assets on the business, right?
Yes, correct.
Yeah.
Correct. Well,
okay.
My book, I don't know if you can see this on the thing.
Yeah, can see it. Yep.
Financing the Unbankable Deal. It's on Amazon. It took me 9 months to birth this baby.
Took me 3 years, if it makes you feel any better. So,
it's writing a book is a lifestyle, isn't it?
I did it with a partner because I wasn't going to do it alone. No friggin' way. I would have never gotten it done if it wasn't for my co-author.
Yeah. Yeah. It's a job. It's a lifestyle, but anyway, the premise of the book is how to, and I get a subtitle. The subtitle is How to Buy Commercial Real Estate with the Bridge Loan Investor Success Strategy. Okay.
Okay.
And where I come at this is most deals are not bankable. The vast majority, and I'm saying, and I saw the stat somewhere, like 85% of commercial loan applications are rejected.
Really?
Yeah.
For real estate purchases?
Yeah.
Wow.
Yeah.
And
It's huge for a variety of reasons. Okay.
Okay.
And but there's a lot of good deals
that are passed up on.
That the bank said, yeah, we're going to do it, but that's a good deal. Like, what are you talking about? What do you mean?
Right.
And so our what we call BLISS method, our Bridge Loan Investor Success Strategy, goes to how do I take those deals that they're not bankable, but they're good deals, and still get them done. We all see these deals, Mitch. We all drive by example, a vacant hotel. It's been vacant for 5 years, 10 years. It's an eyesore. And then, a year or two later, we drive by it again, and all of a sudden it's got completely renovated, and it's a assisted living facility, right? And the parking lot is full because the moment they open, they fill that thing up because demand is so great. Flow. All these baby boomers at 10,000 a day turning 75.
Yeah.
You can't build enough of them, right?
Right. No.
And so how did they get that vacant building that was not cash flowing, that had been abandoned, no bank would touch it? Where'd that funding come from?
Right, because the banks, they want no risk, it seems, in most cases, right? They want to lend when the facility's full, all the work's been done. They want cash in the bank. So they're going to give you $2 million. They want collateral on the real estate. And then they want you to have $2 million in the bank. Like, well, what's the point? If I had
Bob
$2 million in the bank,
Hope famously said, banks are the places that give money to those who don't need it.
Right. That's always it seems that way all the time, but we know deals are getting done, like you said. So
right,
so
and that's where our unbankable deal comes from, because with the bridge loans that we do, the deal can be vacant. It could be no cash.
The bridge loan meaning it's a bridge from the vacant property, fixing it up, and then they refinance in a shorter period of time.
I want to leave it broader than that. The bridge is here. It's a non-bankable deal for a variety of reasons. Okay. And I need the money to bridge me over to this point where it is bankable. Right. Because example, it might be not bankable because I could have a time issue where this is the 27th of October and I got a tax problem and I got to get out of this thing by December 15th.
Right.
Okay, let's say
a bank can't
and
fast.
There's no ifs, ands, or buts. I'm going to lose this deal. I'm going to have a huge problem. The bank can't close a swinging door that fast.
Right.
Okay. So it might be 100% occupied. It might be cash flowing like crazy. I may have great credit. But they just can't process.
Right. They don't move that.
They
fast.
just don't move that fast. Right. So how do I get a deal done in 3 weeks? And I remember, you may remember this story. The founder of FedEx, right, wrote a paper for his master's thesis, right? And the professor gave him a D, right? He's like, man, this is a terrible idea. It'll never work. He's like, what are you talking about? Why would people pay to have something tomorrow when the post office will have it there in like 5 days, right? And you remember their slogan forever, for like decades.
When it has to be guaranteed.
When it absolutely, positively has to be there overnight.
Yeah.
Right?
Yeah.
And those people aren't going to pay 25 cents. They'll pay $35.
Right.
Right?
Yeah, because it's not reliable. They can't wait 5 days. They're doing a deal. The paper's got to be there to close, let's say. We got to overnight a package. Yeah. It's funny that he got a D.
And the bridge loans are kind of like that on the lending side when you absolutely positively have to close the deal.
Right. Maybe you're doing an exchange and you got to get into this new property, or it's going to blow the exchange. You pay taxes and everything. You got to do
Exactly. Or
Right.
maybe you got a seller who's going through a divorce, right?
Yeah.
But maybe I had this happen. The wife don't know it yet.
Oh,
right.
okay.
So listen, I got to sell this thing because, per a certain date, I'm going to be in divorce court and she's going to get half. So I need to,
So
I need to get out of this thing. I had two
Right.
partners. I used case studies in my book where one partner was getting a divorce and the other partner's like, listen, man, you don't like your wife. I don't like your wife either. I cannot be partners with your wife. So we need to get out of this deal and I need to exit you out as a partner. So we were doing a refinance, right? And I'm trying to get him the loan and get him the cash out to do the buyout out of the partner before the divorce attorney is going to have the documents filed, right?
Right.
And so, that's where bridge loans come in. And you could have situations where, again, the property could be vacant, not cash flowing.
Right.
There's there could be occupancy could be an issue. And they say, like example, you got a strip mall and it's at 50% occupancy.
Yeah.
Bank's not going to do that deal.
Right.
Now the question is, Mitch, is it 50% on its way up to 100?
Right.
Or 50% on its way down to 0?
Right. Was it just renovated and they're starting to fill it up, or is it dilapidated and people are moving out?
We just signed CVS as a new anchor tenant on this thing. And now we've got DaVita Dialysis coming in. They're going to pick up 15,000 square feet. We got, so, you know what? This is not going to be a retail strip center. This is actually going to be a medical strip center.
Yeah, that raises its value. But they don't look past that stuff.
Well, they see right now it's a 50% vacant. It's not medical right now. It's a failed retail right now.
Right.
So that's where the bridge comes in. We give them the money. They do the acquisition. They make the change in tenants. They upgrade the property, and it goes from a $2.5 million value to a $5 million value.
Refinance.
And then they can refinance with the bank, if they choose to go that route. But the higher rate of interest that I'm going to have to pay on a bridge, or maybe the higher points that I have to pay, are nothing compared to the $2.5 million of potential profit that I'm going to lose if I don't get this deal done.
Right. Well, that's the world of difficult lending, right? People are like, why would they do that deal? Well, there's probably some reason that they needed the money because they're going to lose the deal, or their approvals are expiring and they need to get a shovel in the ground, they need to get it going, or the contractor's walking off the job because he's got something else going on, whatever it is. And you pay the extra points. But you're right. It's just a business decision. It's not like you're moving your house and shit, now I got to pay 9% because the market's up. I can't even afford that. I'm going to squeeze in.
Because I tell people in my book, when is it not appropriate to do a bridge loan? Easy. When you can do bank financing.
Right, of course.
When it qualifies, when you got time, right? All the universe has aligned perfectly correct for you to get that done. That's when you do it.
Yeah. Now, bridge is short term. So, is there a point at which they have to refinance? They got to get out of this loan for you. Or
typically, bridges are anywhere from, on the low end, 6 months, to the high end, 36 months, 3 years.
So you're talking
most of the time they're 12 months. The vast majority are 12 months. If you're doing construction projects, then that's when they can get to 2 years, 3 years.
Right. Yeah. Okay. And some of that I know flips to traditional financing, right? They'll do, but even that traditional construction financing, you need time and you need all the plans and everything you got to do.
Right.
Yeah. It's a big market that businesses couldn't operate without this secondary market, bridge loans.
Absolutely. And example with your business owner listeners, right? I need a business loan, but COVID killed me. Okay. And I just had this happen about 6 months ago. the bank said, hey, we need 2 years tax returns, right?
Right. They're not going to look good.
And they were okay because 21, they were fine. 21 and 22, they were great, right? And then once again, they got deep into underwriting. Also, the bank says, oh, we need 3 years. And the guy's like, 3 years? 2020 was terrible.
It was COVID, right?
It was COVID, right? So he's like, you don't want to do my loan. That's what you're, you don't want to say it. Right. But there's something else that's happened. And so now all of a sudden you're going to throw on 3 years when you knew at the beginning, I told you that COVID was terrible, but the last 2 years I'm good.
Right.
Right. So it's like, okay.
Right. They knew COVID happened. Everybody knows it. So
yeah, exactly. So we did a bridge, right, to give him time so that now when he goes 3 years, and he goes 21, 22, and 23,
right,
he'll be okay. And he'll qualify at that time for, a traditional bank loan or SBA loan or something like that. Yeah. Whereas now it's like, yeah, he can't do it.
Got it. So are there things that business owners need to be aware of that they should be doing when running their business, keeping their finances or whatever, that make them more bankable when
I'll tell you the key thing. The most important thing for your business owner listeners that want loans in the future.
Right.
Okay.
Yeah, there's a building next door and they know it's just a matter of time for the old guy says, I'm going to sell.
You know that joke about the farmer, right? He doesn't want all the land. He just wants the land next to his.
Yeah. Yeah.
Right. He just wants the land next to his. Right. The business owner client I mentioned earlier, the building next door was 30,000 square feet. It wasn't across town. It was next door.
No. Yeah, he wanted
it. It gave him the expansion and the least disruption to his organization. Right. It was perfect. Yep. So I got to get that building. Right.
Yeah.
The thing that he did that was awesome, he had cash flow and he showed cash flow. What a big, huge mistake a lot of business owners make, they write down everything and they praise I got the best accountant known to man. I had $5 million in revenue and had $30,000 in profits.
Right.
I went to $10 million in revenue and I still had $30,000 in profits.
Right.
Right. And when you go to the bank says, well, dude, your mortgage payment is $10,000 a month. You're only clearing $30,000.
Right. How's that possible?
There's no money.
Yeah.
For a mortgage.
Right.
Oh, well, come on, guys. I mean, we make money. We're making money. Right. Look at our revenue growth. Yeah. But see, here's the problem. We use tax returns. This is the bank. We use tax returns to document your income statements. Right.
Yeah.
And you'll lie to the government. So you're saying to me as the banker, I'm going to lie to that guy who could put you in jail, but I'm going to be totally truthful to you.
Right. Yeah, no, it's a problem. It's a problem because people don't want to pay taxes. And they don't want to pay taxes. And they go and they say, well, the only thing we can actually rely on is your bookkeeping and your tax returns. Make sure they line up. And then you're like, well, you don't show any profit. Yeah, well, because we don't want to pay taxes. Okay, well, we can't lend.
Right.
To you, it looks like you can't afford anything.
Right.
How are you paying for it now? Yeah, absolutely. It's just nuts. Well, I appreciate it. The book's available on Amazon?
Yes. Financing the Unbankable Deal.
Okay, we'll put a link in the show notes. And I hope
and we also have a website, financingtheunbankabledeal.com.
Okay, good. We'll put that link in the show notes as well. Mm-hmm. And Malcolm, I appreciate sharing insight into lending and what small business owners should do. And they should think twice about, just accounting and running their business so they can pay as little tax as possible, because then they end up with, they can't expand. They can't grow. Sometimes you got to pay tax.
Sometimes you got to pay. You show you're profitable. Show your profits are going up every year. You will always be bankable.
Right. Absolutely. All right. I thank you for coming on.
Hey, thanks for having me. It was an honor.
Thank you for listening to this episode of The Accidental Entrepreneur. Opening and closing music written and performed by Howie Moskovich and made to order music. For information about Howie and his music services, please follow the link in our show notes. If you like the podcast, please tell others about us. You can find us on Apple Podcasts, on Amazon Music, Spotify, Google Podcasts, and most of the other podcast directories. If you like what you hear, please leave us a 5-star review and feel free to share our episodes on social media. If you have any questions or comments, ideas for the show, or you'd even like to appear as a guest, reach out to us by email at info@beinackerlaw.com.
The Accidental Entrepreneur is hosted by Mitch Beinacker and produced by Beinacker Law. If you'd like to learn more about our business and legal services, you can find us on social media or visit our website at beinackerlaw.com. Thanks for listening, and be sure to subscribe to our feed to be notified of all future episodes.